Hi guys, and thanks for joining. Today we're going to be looking at consolidation methods. And the example we're going to be using is a hypothetical company A which owns 80% of company C and the remaining 20% are owned by company B. There's two methods of consolidation which are in use, which is the full consolidation and the equity method. There's also a third method which is called the proportional method, but note that today for the most part only the equity method is still in use. As of 2013, the International Accounting Standards Board, IASB, abolished the use of the proportional consolidation, and it's no longer recognized by the IFRS. In the full consolidation, the philosophy is that you're considering the subsidiary as fully owned. The condition for this is that you own more than 50% of the voting rights. The assets and liabilities are added at 100% and you control and you create a so-called non-controlling interest. The sales and costs are also added at 100% and a share of net income attributable to the non-controlling interest is subtracted. On the other hand, for the equity method, you consider the subsidiary as a financial investment. Usually you require significant influence, which means 20 to 50%. The shares owned are added as a financial investment on the balance sheet, and a share of net income owned, proportional to the percent of ownership, is added on the income statement. So back to our example. Today we're going to focus on the case of company A, which owns 80% of company C, and where they're going to use the full consolidation. In a separate video, we'll cover the company B to company C relationship. So let's take a look at the balance sheet. On the left-hand side, you've got the unconsolidated accounts. And something to keep note of is the line item investments in C. Now, let's assume that we consolidate these two accounts, so company A and company C. So you start off with the assets. And so here you add up the asset-like items. So the 100 plus the 8. You add on to this the assets of company C, so the 15. And then you subtract out again the investment in C. So you end up with 115. Then on the liabilities side, you just add up the liabilities. So 58 and 5 in this case, which gives you 63. Then you move on to the non-controlling interest, which is the portion that you don't own in company C. So in this case, company A owns 80%. So you times 1 minus 80%, so 20% times the equity of company C, which in this case is 10. So 20% times 10, which gives you 2. And then lastly, you do the equity. And so here what you do is you start with 50, which is company A's equity. You subtract out the investment in C. And then you add back, or you add the portion that you own, which is 80 times 10, which is 8 again. So you end up with 50. And this is how you consolidate the balance sheet. Next, we consolidate the income statement. And so here again on the left hand side is the unconsolidated accounts of company A and C. Now when we consolidate, we start with the sales and we just add them together, so 130. Then we do the same with the costs. So I've just simplified the balance sheet here. We just add 70 and 10, it's 80, and we end up with 50, which is the same as if we had added the two net incomes together. Now this is where it gets interesting. Now you have to subtract out the net income which is attributable to the non-controlling interest, because your company records 50 in sales, but actually you only get, the way to think about it is that you only have really right for 80% of this, because you're only owning 80%. So you would subtract out the net income that is attributable to the non-controlling interest. So 20% of C's net income. So 20% of 20 gives you 4. And lastly, it gives you the net income group share. So this is 100% of A's net income and then 80% of C's net income, which is 46, or the same as doing 50 minus 4. Now lastly, let's look at the cash flow statement and the balance sheet at the end of the year. So let's just assume that two things. The first is that subsidiary C pays a 40% dividend for the year, and that there's no capex or D&A and no deferred income. So some simplifying assumptions. So the cash flow statement. So you remember the whole thing with net income, group share, and all of this. So basically, you start off with the bottom of the income statement, which in case you've forgotten is the net income group share. So the 46. Then you add back the net income attributable to the non-controlling interest, because although the company B, which owns the 20%, has a right on this 4 of net income, there's no real cash flow because it's just their right, and you record on the income statement, but here we're doing the cash flow statement, so it's about the actual cash flows. And so you add back this 4, so you end up again with the 50 net income, but you subtract out the dividend that is paid to this non-controlling interest. And so here we said that subsidiary C pays 40% of dividends, so you would record 40% of the 4, and the 4 is the net income attributable. And so at the end, you'd end up with 48.4 in cash. It's a little bit confusing, so maybe just go a little bit back in the video, have another look at the balance sheet, the income statement, and then how this flows into the cash flow statement. Now, what would happen with the balance sheet? So you would start again with the 115, which was the original assets, and you would add on to this the change in cash, so 48.4. The liabilities would be unchanged, but then the non-controlling interest would change. And so basically here you would start with the original non-controlling interest, which was the 2. Then you would add on to this the net income attributable to the non-controlling interest and subtract out dividends paid. And lastly, for the equity group share, here you add the 50 in the original equity, and then you add on to this the net income group share. So this gives you 96 and the balance sheet balance sheets. Thank you so much for watching, and comment below if you've got any questions or remarks.